Welcome to Money Wizard Frontiers, your ultimate destination for mastering personal finance and investing. In our first video, we explore the fundamentals of budgeting, helping you take control of your finances and plan for the future. Next, we tackle debt management strategies, offering tips and techniques to pay off debt efficiently and regain control of your financial life. Learn how to save money on everyday expenses in our third video, where we share practical tips to help you stretch your dollars further. Unlock the secrets of credit scores and reports in our fourth video, gaining insights into how your credit health impacts your financial well-being. Discover the various types of investment accounts available and learn how to choose the right one for your financial goals in our fifth video. Finally, embark on your investment journey with our sixth video, where we provide an introduction to investing and equip you with the knowledge to start building wealth. Stay tuned for these essential topics and more as we guide you on your path to financial mastery. If you've ever struggled to manage your money effectively or wondered where it all goes at the end of the month, you're in the right place. In this video, we'll walk you through the basics of creating a budget that works for you. Budgeting is like a roadmap for your finances. It's a plan that helps you allocate your income towards your expenses, savings, and financial goals. By creating and sticking to a budget, you can take control of your money and make informed decisions about how to spend and save. Step 1. Calculate your income. The first step in creating a budget is to determine your total income. This includes your salary, wages, freelance earnings, side hustle income, and any other sources of income you may have. Make sure to account for all sources of income, whether they're regular or irregular. Step 2. List your expenses. Next, you'll need to list out all of your expenses. Start with your fixed expenses such as rent or mortgage payments, utilities, insurance premiums, and loan payments. Then move on to your variable expenses such as groceries, dining out, entertainment, and transportation. Don't forget to include irregular expenses like car repairs or medical bills. Step 3. Set your financial goals. Now that you have a clear picture of your income and expenses, it's time to set some financial goals. Whether you're saving for a vacation, a new car, or retirement, having specific goals in mind will help you prioritize your spending and stay motivated to stick to your budget. Step 4. Allocate your income. Using the information from your income, expenses, and financial goals, it's time to allocate your income accordingly. Start by covering your fixed expenses, then allocate money towards your savings goals, and finally allocate any remaining funds towards your variable expenses. Remember to leave room for flexibility and adjust your budget as needed. And there you have it, a basic guide to creating a budget that works for you. Remember, budgeting is a tool that can help you achieve your financial goals and build a secure financial future. It may take some time to find a budgeting method that works best for you, but don't get discouraged. Keep tweaking and adjusting until you find a budget that helps you reach your goals. Video, we'll discuss debt management strategies to help you pay off debt efficiently and regain control of your financial future. Let's dive in. Before we delve into strategies, let's first understand why debt management is crucial. Debt can be a heavy burden, weighing down your finances and limiting your ability to achieve your financial goals. By implementing effective debt management strategies, you can take charge of your debt and work towards a debt-free future. The first step in debt management is assessing your current debt situation. Take stock of all your debts, including credit cards, loans, and other obligations. Make a list of each debt, including the outstanding balance, interest rate, and minimum monthly payment. Once you've assessed your debt, it's time to create a debt repayment plan. Here are a few strategies to consider. Debt snowball method. List your debts from smallest to largest balance and focus on paying off the smallest debt first while making minimum payments on the others. Once the smallest debt is paid off, roll that payment into the next smallest debt, and so on. Debt avalanche method. List your debts from highest to lowest interest rate and focus on paying off the debt with the highest interest rate first while making minimum payments on the others. Once the highest interest debt is paid off, move on to the next highest, and so forth. Debt consolidation. Consolidate multiple debts into a single loan with a lower interest rate, making it easier to manage and potentially saving you money on interest. Balance transfer. Transfer high-interest credit card balances to a new card with a lower or 0% introductory APR, allowing you to pay off the balance more quickly. Here are a few additional tips to help you succeed in your debt management journey. Create a budget. Establish a budget to track your income and expenses, ensuring you have enough money to cover debt payments while still meeting your other financial obligations. Increase your income. Consider ways to increase your income, such as taking on a side hustle or freelance work to accelerate your debt repayment. Negotiate with creditors. Contact your creditors to negotiate lower interest rates or more favorable repayment terms, making it easier to pay off your debt. Stay motivated. Stay focused on your goals and celebrate small victories along the way to keep yourself motivated and on track. And there you have it, debt management strategies to help you pay off debt efficiently. By taking proactive steps to manage your debt, you can work towards a brighter financial future free from the burden of debt. Saving money on everyday expenses. From groceries to utilities, there are plenty of opportunities to cut costs and keep more money in your pocket. In this video, we'll explore practical tips and strategies to help you save money on your day-to-day expenses. Let's get started. Before we jump into specific strategies, it's important to take a step back and assess your spending habits. Take a look at where your money is going each month and identify areas where you could potentially cut back. Are you spending too much on dining out? Do you have subscriptions you no longer use? Understanding your spending patterns is the first step to saving money. Now, let's dive into some practical tips for saving money on everyday expenses. Create a budget. Establish a budget that outlines your monthly income and expenses. This will help you see where your money is going and identify areas where you can cut back. Meal planning. Plan your meals for the week ahead of time and create a grocery list based on those meals. This can help prevent impulse buys and reduce food waste. Use coupons and discounts. Take advantage of coupons, promo codes, and discounts to save money on groceries, dining out, and other expenses. Shop smart. Compare prices, buy in bulk, and look for sales and clearance items when shopping for groceries, clothing, and household items. Reduce energy usage. Lower your utility bills by turning off lights and appliances when not in use, using energy-efficient appliances, and adjusting your thermostat. Cancel unused subscriptions. Review your monthly subscriptions and cancel any that you no longer use or need. DIY. Consider doing things yourself instead of paying for services. This could include cooking at home, doing your own home repairs, or cutting your own hair. Negotiate bills. Call your service providers and negotiate lower rates on your cable, internet, and phone bills. Use cashback and rewards programs. Take advantage of cashback and rewards programs offered by credit cards, apps, and retailers to earn money back on your purchases. Set savings goals. Set specific savings goals and automate your savings to ensure you're consistently putting money aside for the future. And there you have it, practical tips for saving money on everyday expenses. By implementing these strategies, you can take control of your finances and work towards your financial goals. Understanding credit scores and reports. In this video, we'll demystify what credit scores are, why they matter, and how you can manage them effectively. So let's dive in. First things first, what exactly are credit scores and reports? Well, your credit score is a 3-digit number that represents your creditworthiness, essentially how likely you are to repay borrowed money. It's based on information from your credit report, which includes details about your credit accounts, payment history, and more. So why do credit scores matter? Your credit score plays a crucial role in many aspects of your financial life. It can impact your ability to qualify for loans, credit cards, and even apartment rentals. Plus, it can affect the interest rates you're offered, potentially saving you or costing you thousands of dollars over time. Now, let's talk about what factors affect your credit score. While credit scoring models may vary slightly, they generally consider factors such as payment history, your track record of making on-time payments, credit utilization, the amount of credit you're using compared to your total available credit, length of credit history, how long you've had credit accounts open, types of credit, the variety of credit accounts you have, such as credit cards, loans, and mortgages, new credit, recent inquiries and new accounts opened. Now that you know what goes into your credit score, let's discuss some tips for managing it effectively. Pay your bills on time. Consistently paying your bills on time is one of the most important factors in maintaining a good credit score. Keep your credit utilization low. Try to keep your credit card balances low relative to your credit limits. Monitor your credit report. Regularly check your credit report for errors or suspicious activity and dispute any inaccuracies. Limit new credit applications. Avoid opening multiple new credit accounts in a short period, as this can lower your score. Build a positive credit history. Establish a history of responsible credit use by keeping accounts open and in good standing over time. And there you have it, a crash course in understanding credit scores and reports. By understanding how credit scores work and taking proactive steps to manage them, you can set yourself up for financial success. The right investment account. With so many options available, it can be overwhelming to decide which account is best suited for your financial goals. In this video, we'll explore the different types of investment accounts and help you determine which one is the perfect fit for you. Let's get started. Before we delve into specific types of investment accounts, let's first understand what they are. An investment account is a vehicle that allows you to invest your money in various assets, such as stocks, bonds, mutual funds, and more. Each type of investment account comes with its own set of rules, tax implications, and advantages. Choosing the right account is essential for maximizing your investment returns and achieving your financial goals. Now, let's explore some of the most common types of investment accounts. Individual retirement accounts, IRAs. IRAs are tax-advantaged retirement accounts that allow you to save for retirement while potentially reducing your taxable income. There are two main types of IRAs: traditional IRAs and Roth IRAs, each with its own set of tax benefits and eligibility requirements. For 401k and other employer-sponsored retirement plans. 401k plans are employer-sponsored retirement accounts that allow employees to contribute a portion of their pre-tax income to their retirement savings. Many employers offer matching contributions, making 401k plans an attractive option for retirement savings. Taxable brokerage accounts. Taxable brokerage accounts are investment accounts that allow you to buy and sell a wide range of investments, including stocks, bonds, mutual funds, and ETFs. While these accounts don't offer tax advantages like retirement accounts, they provide more flexibility in terms of access to your funds. 529 college savings plans. 529 plans are tax-advantaged savings accounts designed to help families save for education expenses, such as tuition, fees, and room and board. These accounts offer tax-free growth and withdrawals when used for qualified education expenses. Health savings accounts, HSAs. HSAs are tax-advantaged accounts that allow individuals with high-deductible health insurance plans to save for qualified medical expenses. Contributions to HSAs are tax-deductible, and withdrawals for qualified medical expenses are tax-free. Choosing the right account for you. Now that you're familiar with the different types of investment accounts, how do you choose the right one for you? Consider the following factors: your investment goals, your time horizon, your risk tolerance, your tax situation, any employer-sponsored retirement plans available to you. By carefully evaluating these factors, you can select the investment account that aligns with your financial needs and objectives. And there you have it, a guide to the types of investment accounts and how to choose the right one for you. Whether you're saving for retirement, education, or other financial goals, selecting the appropriate investment account is essential for success. Whether you're a complete beginner or looking to brush up on the basics, this video is for you. Join me as we explore the fundamentals of investing and learn how to get started on your investment journey. Let's jump in. Before we dive into how to get started with investing, let's first understand what investing is all about. At its core, investing is the process of putting your money to work to generate a return. Instead of letting your money sit idle in a savings account, investing allows you to potentially grow your wealth over time through the power of compounding. Now that we have a basic understanding of investing, let's explore some key concepts you need to know. Risk and return. Every investment comes with a certain level of risk. Generally, investments with higher potential returns also come with higher risk. It's essential to find a balance between risk and return that aligns with your financial goals and risk tolerance. Diversification. Diversification is the practice of spreading your investments across different asset classes, industries, and geographic regions. This can help reduce risk and protect your portfolio from market fluctuations. Time horizon. Your time horizon refers to the length of time you plan to hold your investments. Generally, the longer your time horizon, the more risk you can afford to take, as you have more time to ride out market fluctuations. Asset allocation. Asset allocation involves dividing your investment portfolio among different asset classes, such as stocks, bonds, and cash. The right asset allocation depends on factors such as your investment goals, risk tolerance, and time horizon. Now that we've covered the basics, let's talk about how to get started with investing. Set clear goals. Define your investment goals, whether it's saving for retirement, buying a house, or funding your child's education. Having clear goals will guide your investment decisions. Educate yourself. Take the time to educate yourself about different investment options, strategies, and risk factors. There are plenty of resources available, from books and online courses to financial advisors and investment websites. Start small. You don't need a large sum of money to start investing. Many brokerage firms offer low-cost or commission-free investment options, allowing you to start with as little as $100 or less. Diversify your portfolio. Spread your investments across different asset classes and industries to reduce risk and maximize potential returns. Stay disciplined. Investing is a long-term endeavor, and it's essential to stay disciplined and stick to your investment plan, even during periods of market volatility. And there you have it, an introduction to investing and how to get started on your investment journey. By understanding the basics of investing and following these simple steps, you can take control of your financial future and work towards your long-term goals. If you found this video helpful, be sure to give it a thumbs up and subscribe to our channel for more valuable tips on personal finance and investing. Thanks for watching, and until next time, happy investing.